does it make sense to just level set for our audience, maybe at a 30,000 foot level? What do we mean when we are talking about private capital? Maybe, Robert, you want to start with
Sure,
you?
happy to take that up. So the term private capital is largely as a contrast to the publicly traded companies on various stock exchanges, the Nasdaq, the New York Stock Exchange. Private capital really amasses a large, high volume amount of capital that is directed for opportunities that are not publicly traded in its simplest form. So other names you would hear are the private equity marketplace, the private credit marketplace, venture capital, growth equity, but all of those are forms of private capital.
Yeah, okay, perfect. Great. So with that understanding, maybe you guys could give us some just insights into what are some of the trends that you're experiencing in the private capital space right now. Emily, maybe jump over to you.
Yeah, absolutely. I think one of the things that what we're seeing is that there's longer hold periods, at least after, the IPOs back in 2021, 22. A lot of private capital has been holding on to companies, ensuring that they're really in a good operational place, as well as the financial metrics to be able to stand alone as a public company. So there's always some sort of exit if it's private equity or venture capital that the investors are looking towards. But in recent years, there's been longer holding periods. Obviously, M&A is still a factor in regards to private capital and making companies even bigger to become public. And there's some that trade hands between private capital owners between years. So I would say that the longer hold periods, the expectation that the companies are larger and growing and excelling in their space, as well as the potential that the exit isn't an IPO.
Yeah, Robert, anything to add?
Yeah, I think the other big trend, and we can't get away from these two little letters, AI.
Mhm.
AI is a huge trend in the marketplace, and it really is having the it's really changing the lens through which we look at companies. There are companies today that if you think about them in an AI reform model, what are they going to look like if they're an AI centric company? If they apply the technology and if they fully leverage what's available from an AI standpoint. And then there are the companies that are examining, they're not going to be able to change or not going to invest to change that much. And they're worried about the impact AI is going to have on them. Will AI cannibalize, their marketplace? Will it destroy their monetization models? So I think that AI is a big trend. And then the last one that I would mention is companies that are really just trying to get healthy. Because you have a lot of companies that were invested 7, 8 years ago, which is a long time in private
Mhm.
capital. And those companies have gone through, very, very tightened markets. They've been impacted in some ways by unforeseen issues like tariffs, um, uh, Doge changes in other business and industry models. So I think there are companies that are trying to get healthy. And if they're, impacted by private equity, they're using the toolkit to do that. They're recapitalizing some of the companies, they're adding additional management, and a variety of things like that. So all of those, I would say, would be trends that we're seeing.
Yeah, that's let's just stick on that piece just a little bit and interesting that you said help and healthy. But so we're hearing a lot about the private credit
Mhm.
specifically right now and it seems like every day there's a headline around private credit and this $3 trillion industry. It's getting a ton of coverage. So related to some of those companies getting healthy, where is the interplay of private credit with private equity? And why are the GPs recalling capital in some cases? And what are the implications there for the LPs? I know that's a lot of questions, but anyone
Yeah,
want to jump in there?
let me I'll tackle some of it and leave some of it for Emily. First, you have to think about what the private credit market is, right? The private credit market filled a need and a void left by the banks when banks decided that they were no longer going to lend, or frankly, they were regulated out from lending to
Yeah.
certain types of companies, right? And that's a grand result of the great financial crisis. And so you have an entire industry of people that are former bankers that liked private equity returns, but really liked the safety security of protected debt, right? So it's a relatively new industry that is
Hmm.
a retread of a number of different industries that is lending into a variety of situations, very opportunistically lending into private equity, very opportunistically recapitalizing long-standing companies to help them retool. And when you have that much capital flow in, you're going to, even if you don't lower the underwriting standards, lots of things are going to get funded by someone that may not have been fundable in the past. And I think that's what you're seeing. So you're seeing investors, their LPs that were saying, look, I want something that's safe and secure, but I want equity-like returns. And when you mash up all of those different elements and you attempt to solve for the return horizons that they're looking for, you're going to see people invest in deals that are not as, if I use the term bankable, as they were when banks were doing those deals.
Yeah, that totally makes sense. Emily, do you want to add anything to that?
I think the only other thing I would add is, in terms of taking on private credit and some of the headlines that there are right now for the private credit organizations or firms that are public, is that they're starting to see defaults. And so they did take on a little bit riskier investment just because that's why it was regulated.
Right.
And the issue is now how to have the returns on those investments, or having to put more capital in to kind of ride it out. So that's another area, and the defaults are coming in a lot of different forms. I mean, some of it is the disruption in the marketplace in regards to competitive advantage, as well as just operational issues that may not have been seen in due diligence. But a lot of private, credit is associated with some more risky, maybe industrial or real estate capital intensive, uh, endeavors. For
Yeah.
example, like data
Can be.
farms and things like that.
Yeah, it can be.
So
So,
maybe not as default ready.
sorry, I didn't mean to talk over you there. So I think this is really interesting from a governance perspective, because if you are a board member of a portfolio company who is either is using private credit, what impact, or if you're in a private credit fund, I should say, what impact is that having on them? Like, it- you know, what are they thinking about, or what should they be thinking about if they are if they're in a if they're in a private credit fund? Just knowing what you just said.
Yeah, I think that it's the for sure the ensuring that the strategy is continuing to be front and center, and if the strategy needs to change in regards to outside factors, either geopolitical or technology associated, just I think it's still the same governance requirements being on the board, looking at all stakeholders, and shareholders in particular. The creditors are our stakeholder, and being able to apply the appropriate judgment and background to the board, right? So it's all the same governance requirements in regards to strategy setting and so forth, but with the expectation that you're also considering people who might not be at the table.
Yeah.
Yeah, I think the other way to look at it is one of your responsibilities as a director, particularly in a private company, is really understanding and rationalizing the capital structure of your
Hmm.
company, right? And capital structure, a fancy way of talking about what types of capital do you have at work, and what's the
Exactly.
purpose and best use of that capital. This is an environment we've seen a lot of turmoil, and in turmoil, people use cash. And the question is, where'd you get the cash, right?
Yep.
Did you get the cash from your equity investors? In which case, you may have a lot more flexibility unless there are covenants around how much equity you need to hold. Did you get the cash from a bank and it's a senior preferred note? And in which case, you're definitely going to have, heavy terms and have a lot of scrutiny over how you use that cash. Or did you get it from a private credit firm, which, by its very nature is going to be a little bit more risk tolerant, maybe a little bit more covenant light, as we would say in the finance world. And even then, you've got to be very prudent and judicious about how you use cash. So all of those are considerations. And as a director, it's not merely checking the three financial reports that you're going to be getting. It's really understanding some of those more esoteric lines, what they mean, and what the implication is to the company.
Okay, exactly. I couldn't agree with you more. And I think if we're used to being public company directors and we're used to working with traditional corporate banks, it's a different language
Yeah.
than when you're looking and working with a non-bank lender. And to your point, where the covenants might be different, that where the cash is coming from is different, but you have the same responsibility, to your point, Emily, whether or not you're a director on public or private, it's the same responsibility in terms of governance. So is this then contributing to efforts to increase the focus of governance within the private capital space? Is this just one of many contributors, or is this the primary driver?
Yeah, I don't think we're at an inflection point where, to Emily's earlier point, that a lot of things are different, right? I think that the general nature of serving on a private company board has been pretty similar since the great financial crisis, right? Do you have a good strategy? Are you observant of potential conflicts of interest, either between manager, between related party entities? Or others, or dependence upon your clients. What's the overall risk that you're taking, and are
Mhm.
you taking that risk for the right reasons, or are you just naturally exposed to it and it's unmitigated? I mentioned capital structure, and lastly, as a director, you above and beyond all of your technical expertise and the experience that you can bring to bear, you should have some market influence as a director. Can you help with customers? Can you help with contracts? Can you help with understanding various markets? So I think all of those issues are issues that are still in play in your board meetings. The one big difference that's always present in private companies versus public companies, the elephant in the room in a public company is time, right? You have to report out quarterly on everything you do, and you get a report card every day in your stock price. And
Yeah.
that's always in everybody's mind because that information and the informatics around that are so prevalent. Almost everything that happens in a public company is pegged to that. Compensation is pegged to it. Strategic capital investment is pegged to it. And the big difference on the private company side is you don't have that clock sitting at the table in the same way. Sure, the
Wait,
private.
hold on, Robert, because in the same at the same time you kind of do because you know this is a limited investment, right? It's
Yeah, but
going to be
it's
3, 5,
different.
7 years if you're in a fund right now.
Fair point, Michelle, but it's different when you have think about in your own life. When you have 5 years to do something versus showing the discipline and the
Like three
trend of
months.
doing it every quarter, right?
Yeah.
It is a very different behavior. You can, for example, decide to have increased CapEx in a private company and realize that, you know what, this is going to squash our EBITDA for a while, right? But we're going to come out of it a stronger, more capable company. If you're going to do that in a public company, you've got a lot of pronouncements to make to the marketplace. Depending upon the size, you better be talking to the analysts out there because you can literally ruin that company if the marketplace doesn't know why, for example, your cash flow or your income is down because you're spending CapEx. So just an example.
Yeah. Okay, that makes sense. Emily, anything on the increase in governance and private capital right now?
Yeah, I would say that something that maybe Robert hadn't touched upon is that typically in private equity or venture, you have the investors at the table. They're they have analysts that are going through and for the fine tooth comb the financials and understanding all the financial metrics and digging into strategy a lot more than in a public company. I mean, yes, there is a little bit of the market telling you, do people agree or not agree? I think it's difficult today, or maybe in the last, I'm going to say 6 years, in regards to the sentiment in the market, because there's things that are perception based and not based on good, sound financial results. There, but in a private company setting or private capital setting, typically you're going to have a founder that's there on the board, as well as representatives of the either private equity or venture fund, and so they do have a voice and they're able to be more involved, sometimes, you know, a little bit more when there's not certain experts that are at the company. So there's a missing, you know, leader, for example, a finance leader. Some private companies don't have CFOs, and so the venture capital fund has to have a little bit more depth in regards to looking and scrutinizing the financials. So I mean, I think that Robert captured everything, but the only thing I would add is that you have to consider that the people are at the table that actually have invested heavily into the company.
Yeah. Yeah, which is definitely a difference. We always hear the old adage for public companies, it's noses in, hands out. Yeah, you know, it doesn't feel like that's the same on the private side, on private equity or venture capital. There's a lot more involvement on a day-to-day basis. So not day-to-day, but a lot more involvement. Sometimes day-to-day, depending upon what's going on in the
Yeah, if there's a
organization.
transaction or
Yeah, if
some
there's a
pivot
transaction.
point. Hmm.
Exactly. Um, is that typically true though? So maybe you can tell us a little bit about what is it more like to be a private director?
Yeah, I'll just start in terms of the difference. I mean, the governance standards are very similar, and especially if you're independent going on to a private capital board or portfolio company, you know, you still have your duties that you need to think about every time you're in that boardroom. You're no longer representing yourself. You're considering the stakeholders, but there is a mutual respect. So if you're joining a you know, a portfolio company board, you need to feel comfortable that they're going to respect your voice in the room, that you're not always going to just be overridden. So there's a lot that goes into that in regards to, you know, interviewing, not yourself being interviewed, but you interviewing the investors that are that are selecting you for an independent board position. And so just understanding that dynamic is really important. No, and then there's also the idea of understanding who the majority vote's going to be, right? So there's a lot more diplomacy and understanding of the different ways and perspectives that people are coming at a problem at a company, maybe not a problem, but a strategy, and making sure that you have that in mind. But at the end of the day, you vote your vote, and it's based off of your own experiences as well as what you believe is best for the company.
Yeah,
Yeah, I think Emily covered most of it. I'll just sort of frame out who's around the table.
that'd
So,
be great.
you know, in an early stage company, there's no question that the founder and maybe co-founders will both be directors of the company sitting at the table. And as I bring each one of these characters onto the table, I'll talk a little bit about how you have to treat them. There's a lot of respect, at least when it's a healthy environment, that needs to be paid to the founders because this is their baby. They've got generally a lot of emotion and a lot of their capital, their personal wealth tied up into it. And what I try to do in a situation like that is constantly measure the decisions and the feedback that they're giving you with their emotional connection to it, right? People issues are often very difficult to deal with around founders because there's always some favor that someone has done or some debt of loyalty that someone has shown that comes up that's frankly not always within the fiduciary boundaries that you as a director hold. But it's important to deal with founders in that way. Unfortunately, when the company struggles, it changes, right? How that founder gets dealt with and handled changes because you may be in a transition period or there may be a pre-transition that, is not, fully known by all of the board members yet. So that's one set of issues. The next would be the lead equity holders, right? The
Hmm.
private equity, venture capital firm, family office, whoever that is. It's pretty obvious who they are because they're going to have oftentimes the last word on most things because it's their money that's being brought to the table. Again, respect for everyone. But in a lot of cases, you need to figure out where the equity investors, the lead investors are driving and pushing and what they want to see. And then you have to measure that against your own experience, expertise, frankly, integrity to make sure that, to Emily's point, you're either speaking up in support or against, or attempting to, in some nuanced way, move the conversation in a different direction. The other two groups, I'll say quickly, are other independent directors, people like you that, may have some equity interest, but it's not a majority or an overriding equity interest. They're typically bringing expertise. And then the last group would be, in some cases, the private credit or by covenant, certain debt holders that will want to
Hmm.
sit there either because the company has taken on a lot of debt and they want to protect those interests, or they somehow hold, a convertible note or mezz capital that gives them certain rights as well.
So the one I didn't hear you go into detail on was, and again, I'm going to compare and contrast to public and private, is the CEO. So
Mhm.
if it's a founder, yes, but if it's not a founder, if it's gone beyond founder and the founder has either moved to the board or moved on, and you have a new CEO who's brought in by the fund.
Yeah.
Um, how different is that relationship between the directors and the CEO in private versus the relationship in public?
Yeah, what I've found is in most cases, when the CEO is also a board member, they are constantly doing this lean in, lean back in the meeting. Both Emily's laughing because she knows what I'm talking about. A lot of times they're giving the operational report. They're telling you what the company's doing and they're, executing against the strategy. And typically the board has had a voice in at least approving the strategy. But there are also moments where they need to lean back, right? When it's, compensation, they often have to make
Hmm.
a recommendation and lean back. When it's evaluation, they're telling you based upon their engagement with the person, but you ultimately are going to hold the authority to evaluate the CEO to determine whether or not they qualify for their bonus, whether or not they qualify for their equity, measuring against the marketplace. So, yes, absolutely. When the CEO is on the board, for sure. One of the more challenging times is when you have either a new CEO or a CEO that it's been determined is going to be moving on. And those are sort of white knuckle moments where the boardrooms can get pretty testy if people aren't in line or if things are not progressing according to the company's plans. Though that's really a time when the board meetings are a little bit more engaging than if everything's going well and it's steady as she goes.
Good. So that's one area where the board is probably going to get really involved. How involved is the board going to get in strategy conversations and macro environment conversations? Is that a fairly typical um, part of the conversation as well?
I think it's one of your top priorities as a board is to obviously listen to what management's put together based on a knowledge deeper than what the board typically can go into, and bringing it to the table. Are there risks associated with this? Are there opportunities that we're not thinking of? So it's one of the number one priorities that we have as board members is understanding strategy and typically the strategies are considered long range, but in today's age, it's really thinking about it every single meeting and also understanding a lot of the threats that are coming against the company's strategy.
So the
So
reason I ask you that, Emily, is because it isn't the strategy already set by the firm when they make that acquisition, when they are deciding on their thesis, they're already, they already know what they want to do by the time that they exit this in 3 to 5 years, right? So how much influence really is there on strategy as much as the board needs to understand it and be driving the CEO and the team in that direction? That's why I
yeah.
ask.
Yeah, no, absolutely. I mean, I think it can change on a pretty regular basis, especially because of the rate of technology and the competition that's out there and the changing environments. I do believe that talking about strategy at not just the overall level. Oh, well, we're going to exit in 5 years
Yeah,
and
of
we're going to be
course.
selling these widgets. It's getting deeper into how are you going to execute? Do you have the right team? Are you considering the appropriate risks? And are you thinking about advancement or improvements? All of those things are part of our normal conversation. So I think it's something that we talk about on a regular basis. Now, on private companies versus public, most of mine meet quarterly still, just because that's a good way that the CEO can present what they're thinking and getting the feedback from the board from different perspectives, outside in, typically. And I think that that's a very good cadence. Uh, maybe every 6 months was something that was appropriate years ago, but it's really a lot more than that. And when we talk about the cadence as well, um, as board members, we're responsible for also keeping in touch with the company between meetings and understanding whether or not there's something going on, or just checking in. I check in pretty regularly with the CEO and CFOs of my boards that I'm on, just to make sure, is there anything when you think about me that uh, you know, because they know what framework I'm looking at it. I do look at the company from an industry perspective, and I sit on different boards, but they also understand that I'm in more in the finance area. So something might come up that they didn't think about, and just start, um, a good conversation.
Okay, good. Robert, anything to add?
No, Emily covered it.
Okay. So for a while we were hearing a lot of discussion. This is like completely, right turn here. We were hearing a lot of discussion around ESG and making sure that firms and portcos were putting enough focus here. Is this still a relevant topic for private capital today?
You never know how the cards are going to come up when they get shuffled, do you? So I guess it's my turn to lead on this one. A lot of it depends on the culture of the company, who actually the lead investors are, what their priorities are. Um, ESG did not become less important. It became less emphasized, right? And so there are still, I sit on boards that have ESG discussions because it's very relevant. I sit on a heavy equipment construction company board, and ESG is really important to that. What's going on with the environment? How are we treating our employees? ESG was always a Comtrex capital that had a lot of things packed into it. So the real question is, which ESG are you talking about? Are you
Hmm.
talking about diversity, equity, and inclusion, which is a toxified term in the marketplace now? It literally, it may have been toxic for some people all along, but for others, it was very much seen as a competitive advantage. So what I will say is all of the acronyms have become outshoots of the company's culture and the company's priorities, right? And whether you use the term ESG or not, and you still have programs in place that are considerate of how you dispose of your hazardous waste, or how many trees you cut in the production of your product.
Hmm.
Um, whether you report that out or not is all a component of the regulatory component. But there are many boards that have not changed their reporting structure, and everything that was previously required continues to be required, just may or may not be amplified in the same way.
Okay, very good. Emily, anything to add?
No, I think that Robert covered it. I mean, you do look at it from a perspective of, is there something in the operations of the company or the mission of the company that relates to those, three topics? Or how about your employees? How much does it matter to them, and is part of their culture? So that I would just say that it is interesting how maybe on public company boards, you took out a committee that existed solely because you were supposed to be in compliance with this SEC standard. But it really didn't take away from the fabric of the companies that I work with.
Yeah.
They're still really important.
Very good. So when you're in public companies, there are scenarios historically, not so much I think anymore, but in the past where CEOs kind of handpick their boards. And then today it feels like the norm is more you have a nominating committee and they run a process and they present a slate. That's usually based on their board matrix. And then the committee interviews and then the board interviews and the CEO interviews and all of that. So how does private equity or private credit typically identify and select their potential directors? And generally, what is going to be most important to the firm, knowing that there are, several thousand firms, so obviously generalizing here, but how does that differ from what we're used to in a public company with a board matrix and the normal slate? Is it the same? Is it different? Oh, either one of you, whoever wants to go first here.
Emily, do you want to go or I can go?
Maybe you can start, Robert, because
Okay.
mine's pretty plain.
Yeah. So it depends again on what the investment structure looks like. If it was a deal that was done completely by one private equity firm, then you're going to have a cadre of individuals supported by the dominant investor. Some of them may be operating partners that are on the staff of the private equity firm. These are former CEOs and former CFOs that bring deep expertise and are running a general playbook that this private equity firm or private credit firm often runs. You will find industry experts, people that are just super plugged into what's going on in the industry that can very much assist with strategy and with, business development. As Emily said before, there are some companies some private equity firms that don't like CFOs in portfolio companies. They centralize all of that. They may have a controller. They likely will have a controller, but they centralize the functions of the CFO at their level. And then lastly, there can be other individuals that are helpful to the private equity firm or have been helpful to the private equity firm that are good qualified directors that can sit on the portfolio company. And then, as you get smaller, you may have former founders that have negotiated to stay on the board. They've now become a director and they're going to look over the shoulder of the CFO. Caution, enter at your own risk on that one because revisionism and the way I would have done it is can be alive and well. But I would say that the number one goal is still very consistent with the public markets. It's getting talented people on the board that can help with the development, the maturation, and ultimately the exit of that company. But many private companies are not as formal with
Yeah.
skills matrix with coaches for directors and frankly may or may not be using Robert's Rules of Order to drive
Hmm.
structured motions and some of the things that you talk about. It's a culture. It's dependent upon the culture of the portfolio company and more so the culture of the lead
The
investor.
firm. Yeah.
Yeah.
Yeah. Emily, did you want to add anything to that?
Yeah, the only thing is that several of the private capital boards that I'm on, they did utilize a recruiter. to either have me join or someone else. But for the most part, Robert nailed it in regards to private funds already have a list of qualified individuals that they can put on boards.
Yeah. Yeah. And I have seen that they vary, right? I mean, all of this is every firm is different. So some are going to use Robert's rules of orders, and then some are building it as they're going, or every portco is slightly different. So
Yeah,
that makes sense.
I will share one additional trend though, Michelle. Looking at the stage that the company is in, a very early stage, you could see a lot of people around that table that you don't recognize, clearly what their role is. As a company gets closer and closer to IPO, you
Hmm.
start to see the company board formalize in a way that looks very much like a public company because, they're dressing the company, prepping the company and
Yeah.
getting it ready.
Getting it ready.
Yes.
Yeah, that's exactly right. I agree. So, how does so given that slightly different environment, how does the independent director specifically sitting on a private company balance that necessary support for the CEO, but also the focus on the returns for the firm? I mean, it can be a tricky balance. Thoughts around that?
Yeah. No, it is. I mean, it probably will never fully go away in regards to that balance. I mean, it's important to see whether or not the CEO and his or her success in being able to lead the company go into the company and not just be um, a cheerleader or a strategist, but actually going down into the operations and making sure that the results are what are expected by the private capital firm, right? Either it's compliance with um, you know um, credit requirements that they have, or it's metrics that the private capital firm wants to see in regards to rule of 40 or something that they're measuring the company by. When a CEO starts to have problems with being able to, one, articulate the strategy of the company to get to the financial results that are expected, and they start becoming really defensive and not being able to be uh, I guess judicious in regards to looking out from the outside in, that's when we have issues. And obviously the board has a tricky situation if the CEO has controlling interest. Uh, so it is tricky. You try to help them understand. Well, this is what you took this money for, either the private capital or the private equity or the credit. So there's a delicate balance. A lot of it has to do with when you join the board or when someone joins the board, building a rapport with the other board members and the CEO to have that mutual respect.
Yeah.
Yeah, it comes up all the time, right? This is the perennial question,
Yeah.
and I'll analogize it to helping your kid learn to ride a bike, watching your child swim for the first time, or if you have a teenager, watching them drive a car for the first time. If they do it really well and you're confident, it's easy to keep your hands out, to sort of stand back, cheer them on, grab their towel when they need it, or, take them to McDonald's or whatever that looks like. Where it gets tricky is when it doesn't work, right? Because when it doesn't work, you have heightened emotions. And the emotions are typically heightened around who has the most to lose. You will see some of the investors take very strong positions about early fast terminations. They'll wax poetic from, the Bible and literature and everything else. It all comes into the table, where some people want to give a lot of time and others want to, cut it quickly and move on. And so all of those things play out and those emotions have to be balanced. And I think the thing you have to figure out in those moments is where are we going to go, right? Are we going to change the leader, which may in fact require a change in in the company's strategy, which may require taking on new capital? There are all sorts of extrapolated decisions that that one decision makes. And before you change out the CEO, you better think through what all of the other implications
Mm.
are.
Yeah.
And you can we all know it. You can fully tank a company by getting rid of the CEO that has a lot of equity because now you're going to have lawsuits and you're going to be paying out capital that you should be using to expand and grow the business. What I find in situations like that is it's very comforting when you have highly experienced directors that can either validate that this is just a rough patch or that can sound the alarm because this is, a critical issue. And newer directors in those moments, to me, really ought to observe the room and get an understanding of where people's expertise comes from, as opposed to believing just because everybody has a chair that everybody's voice is necessarily equal in that moment.
Yeah, very good. So related to that, I mean, these are challenges that every private company, private equity, private capital board member are going to face at some point in time in their experience. So let's just talk briefly about the compensation structure related to the board members for this type of a board member. So how is it different than board comp? Um, Given all these different things that they are now, going to be exposed to and expected of.
Yeah. So public company boards, you typically have a mix of a cash stipend and equity, right? Typically restricted stock units that vest after a year or an annual basis. And it's, you know, the cash part typically pays what is expected in regards to the tax component. So you pretty much are kind of even, and it's really more about the long term growth of the company. On the private capital boards, it's typically a very small cash stipend, if any, and it's stock options typically.
Yeah, I think a lot of it comes down to what are the investors willing to share based upon the value that a director is perceived to bring. What is the amount of, and Emily accurately described the mix. What's the amount of mix that's going to be required to get the type of people you want? If you're going through executive search firms and hiring people that come with very high expectations, you better be prepared to sort of meet those. Otherwise, your search is not going to be very successful. But in all cases, it should be a couple of things. It should be defensible, right? To the investors, to the shareholders, to the LPs. You want to, when and where possible, peg it to outside comps,
Mhm.
right? To make sure that you're not just sort of, building your own and going in your own direction. And then the last thing that Emily said that I'll reiterate is it needs to be aligned, right? It needs to be aligned with the outcome of the success of the company, not merely directors, they're collecting large fees. And there's no tie to the outcome. And the directors shouldn't want that because it opens them up to liability.
Yeah, and there are a lot of different organizations, recruiting firms and organizations who do provide those comp stats. So it's pretty easy to get an idea of what is kind of the norm related to the size of the company or even industry. So that's great. A couple questions from the audience that have come up. One is around are term limits or retirement ages common on a private company board?
No.
Is it common on public company boards? I mean, I think the trend is that it would be great governance, but I don't have those on my public company boards, and I think that in terms of private company, it would be probably less common. Robert, have you ever run across one that had
I haven't seen
term
anything.
limits or
Not
retirement
not on a
ages?
private not on a private company, certainly on public companies, and when and where you're using a skills matrix and a succession plan, right? If
Yeah.
they have a skills matrix and a succession plan, you're going to have those other elements. And there's going to be sharing. When you fill out the director questionnaire, you're putting your birthday on a public company, and it's going to be published everywhere until you get off of that board, right? Hopefully they don't use new pictures as you get older, but certainly not common on a private board.
Yeah, agreed. Same. Not on private. More and more so on public, or they'll have special language that if you reach X age, for example, then the board has the right to request for you to continue on again. Meaning that you've self-identified by age, to Robert's point, because you filled that out. But then they may say, we want you to stay on even though you've reached this particular threshold. I think there was another question. I'm just looking for it in the chat on any recruiters or forums they should engage with to network with private capital firms or to come across particular board seat opportunities like the ones that we're talking about.
Yeah, for sure. I think it's very important for anybody, particularly the NACD community. It's very important for you to know the recruiters that recruit for your industry and that are recruiting for your profile, not merely for one search, but develop a relationship with them so that you know that you're in their database. They know you by name. I always say if they passed you in the grocery store and they didn't know you, the chances that they're ever going to put you on a board are diminished by that. You want to make sure that they know you. You want to make sure that you're in active dialogue with them, both around the updates to your bio and profile that are very formal, but also just what's going on in your life. The better relationship you can have with them, the more likely you're going to get that phone call. But it is some of the most recognizable names in the tech space. It's going to be Russell Reynolds heavily. In the other operating and industry sectors, you're going to see Korn Ferry, Spencer Stewart, Egon Zender. And then there are a host of what I would call regional boutique specialized firms that specialize in certain companies in certain industries. So you have to do your research around that. But again, can't emphasize enough, you don't want to get just the call for the one search. You want to develop the relationship. And even if the call that you get for the one search is not a fit for you, you want to use that as an opportunity to help the search firm and become a friend to the search firm.
Great. Emily, anything to add?
Yeah, I would say that the only other thing I would add would be that once you have gotten in a position with a large private equity fund, typically, if there is another opportunity that makes sense in regards to your skill set and your industry expertise, that they will reach out to you if you have more capacity, especially if they want another independent on one of their portfolio companies. And most of the folks here that are in the audience are already executives and or retired and are looking at board service or already on boards. But one of the things I've been really thinking about over the last 10 years is the typical you know background of a board member in depending on where they are in industry and leading edge technology. Sometimes you're looking at younger individuals that might still be in operating roles or just rising to their operating roles, and they're just cutting edge in regards to technology that may be pivotal or understanding even of the market. So there are more and more opportunities for people that aren't the typical CEO, COO, executive in marketing. There definitely is some more room to get those voices at the table.
Yeah, I'm just to build on that. I think you're absolutely right, especially again, like public company, a lot of CEOs and CFOs are around the table, or former CEOs and CFOs. But in the private space where it's a smaller board and you are more involved, the skills or the network or the contacts around the table are really being looked to on a much more regular basis. So I think one of the things that private equity or private capital is typically looking for is your example, Emily, is expertise in, say, it's, technology, what's current today, but it could be relationships and network in the industry in which they're operating. So you could make introductions. It could be expertise in an area where the CEO and management team don't have as much of, so that they can look to the board for that expertise. It's almost it's not an extension of the management team. That's not right, but it is almost an extension in that they do want to pull up from the board to say, can you help us with this? I think on a much more frequent basis than you would ever see in public.
Yeah, to extend the point, I think you're also going to see in markets that require and that respect long tenure and deep expertise, beyond tech, you're going to see influential people. So lots of former generals and admirals are going to sit on company boards that are doing business with the government or with the military, because not only do they have the understanding, but they also have, in many cases, the relationship. I
Relationships.
think you're also still going to see a number of academics, particularly if those academics have done research in a particular field, neuroscience, health related, and the like. And then, there's a lot of investment going into education, and you're seeing a lot of, former superintendent, again, academic types that are getting opportunities to serve on those boards. But if you're looking at, six, seven, eight, nine people sitting around a table, and you've got half the seats already taken up by contract on who's invested the capital, you want to have, and I would accept your term, Michelle, an extension of the company. You want to have people that are able to extend the capabilities, articulate for the company, and ease the transition into opportunities.
Yeah, very well said. Okay, any best practices you've seen for evaluating director performance in private boards?
Yeah, it comes back to what you've heard Emily and I both speak to, which is the skills matrix, right? They're going to be in any organization, they're going to be 6 to 10 things, call it, that are highly prioritized in terms of leadership, strategic thinking, team building, financial expert. There's a list, and you can find that list or a good list on any of the search engines. But once a company adopts those, and typically that's going to come out of, a human capital committee or a people-centric committee. Once a company adopts those, you typically find that directors are going to be evaluated first and foremost on their availability. What is their meeting attendance schedule like? Secondly, what areas do they typically opine and provide guidance and insight? Third, how well are they engaging in the things that have been prioritized from a people matrix standpoint, from a skills matrix standpoint? And then, if anybody's doing any long range planning, what does succession look like, right? Who's approaching, 70 seems to be a magic number in a lot of places. Who's approaching, the latter years, or who's getting towards the end of the term? And how do we find somebody that can either extend what those high quality, highly experienced directors are able to bring, or take us in a new direction if we're attempting to change the culture and the positioning of the company?
Great. Emily?
Yeah, I think that also depending on how good the GC is at the company, the more formal it could be. But for the most part, it's a pretty informal process. They just check in every once in a while. If you don't have a nominating governance committee, it's an informal process. It's not like a big checklist that you fill out
Not
and
like an
say,
annual,
are
you
we
fill
hitting
out the
all of these?
survey. Yeah.
Yeah, it's typically what Robert said. Are they involved? Are they responsible for the areas that we think that they wouldn't? And sometimes surprisingly, including some areas where they wouldn't have expected. So
Yeah,
Okay.
I do know of one sort of category that in private companies you're going to find a lot of emphasis, and that would be the mega buyout firms, right? Pick your favorite firm that you've heard of that's managing in excess of $20 billion. They have the human capital resources on their staff to really
To
implement
really have a playbook.
strong people policies, and you
Yeah.
use the right term, Michelle, playbook. And they want to be able to differentiate the value their directors bring to their LPs. So you will see board, scorecards. You will see 360 feedback. You'll see a lot of the Vanguard HR and best practices for human capital. But as you go downscale towards truer middle market firms less than $25 billion, you're going to see far less of that because they just don't have time to focus on it. They're much more focused on outcomes than developing, sort of this repeatable process.
Yeah, I mean, I think there may be playbooks, but the playbooks are probably, well, I know the playbooks are focused more on the results of the portco itself and a
Yep.
little bit less on some of the other things. Although, just as a reminder, again, we're talking about there are over 5,000 private equity firms
Yep.
in the US alone. And so, as we know, they all can come in different shapes and sizes and flavors. And so one last question for you guys, and this one is, how consistent is D&O insurance coverage for PE board members?
I think it's ubiquitous. I've not
Yeah.
I've not been invited to serve on a board that doesn't have it. Now, have I ever seen the policy? I actually have not seen the policy, but usually on an annual basis, they ask you about certain conflicts and certain activities and behaviors that you're engaged in. They want you to list other boards, and when you get those questions, you typically know that there's D&O in place. Also, in your director agreement between you and the company, there's also a conveyance of, indemnification by D&O policy. So I've not seen a board that has paid directors that doesn't have D&O.
Okay,
Yeah.
great. Emily, same.
Agree. Same. I wouldn't join a board that unless they did have
I
the
would say
DNA
it's
policy.
for sure. You got to ask the question. And if you don't ask the question, at least if you have to have some indicator, but because otherwise, yeah, it's definitely a risk. That is all the questions that I have seen and come through the chat. And so I think we are at the point where I'm just going to ask you guys one last question, and that is final key takeaways that you want to share with the audience.
Yeah, I would say that joining boards is not for the faint of heart. It might look very prestigious and something that is extremely fulfilling, but there's a lot of work that goes into it. And not only that, it's about your reputation being tied to a company. And so, really do your homework in regards to joining a company, understand the investors, understand all the players, and see whether or not it's still something you'd like to do. It is fulfilling. It is fulfilling for me. I continue to do it, but there is a lot of hard work involved. And there's times where you think, oh man, one small move, and I'm associated with something that maybe I was not in for when I first joined.
Very
Yeah,
good.
I think the only thing I would add to what Emily said is before you go on this journey, you really need to examine why you want to be on a board, right? Is it merely an extension of your corporate career? Is it, to the point Emily made, is it some, mountaintop gratification that, is going to capstone a career? Or are you engaging in an investment, right? Because you're investing your time, your brand, your expertise. Maybe with certain boards, you're investing capital as well.
Yep.
But really understand what you want and be judicious about the board opportunities you accept based upon what you want. And from there, you have to use the same principles that made you a successful executive, right? You've got to do the work, right? You've got to really understand the strategy. Hopefully, you enjoy the people that you're around, and you do have to pack for the journey. And when I say pack for the journey, realize that it's probably going to take longer and more resources than you anticipate, and go from there.
Very good. I think for me, I think of it as, putting together your board portfolio and being on having the opportunity to serve on both is a great combination. They're very different, but there are merits and challenges with each. And if it is the right opportunity for you at the right firm for the right company, and you feel like you have the opportunity to make a difference there, it can be a great opportunity. But to Emily's point, it also can be very different than what your public company board experience is. So just know that going in, I kind of eyes wide open.